Sandeep Bhatia, Managing Director and Head of India Equities, Commodities and Global Markets at Macquarie Capital, is joining us in the studio. So good to have you in the studio with us, Sandeep.
Thank you.
So my first question is obviously, how have you read into the market mood over the last 2 months and what's been happening? And going forward by the end of the financial year, are there opportunities that cannot be ignored?
I'll just give a summary bullet point of what's happening. There are a couple of things happening within India, and there are a couple of things happening in the US. What's happening in the US is that Treasury bond yields are going to go up. They'll probably reach 4% in a year's time. We will see we have seen strong growth in the US. We have seen the weakening of growth in China. The consensus is that this year is going to be strong for the US, but maybe second half of next year, even the US growth will taper off. The trade war between US and China means that growth in China will remain under pressure. In the background, oil prices went up, but seem to have now moderated. This is not generally bad news for India, except the fact that Fed rates are going up is bad for all emerging markets. Within India, two things are very important. One is that earnings growth is coming back after a long gap of 4 years. Indian bank balance sheets have taken a long time to get repaired. Indian capex story is still a train that we are waiting to arrive for. So that is the India side. But more importantly, finally, we can say with some confidence with the kind of corporate earnings which have been reported that earnings growth is coming back. The near-term uncertainty would be on the politics front. We'll see 2 sets of elections in November. Then we'll see the large national election come through in April. Once we are past that, I think the fundamentals of the Indian economy, which are much stronger than they were in 2014 or even in 2017, will come through in terms of indice performance. So I think earnings and stock performance should follow and should be strong in next year.
So far, obviously, the confidence of foreign investors has been a bit shaken from an Indian perspective. We've been seeing money moving out of markets so far. Do you see that return? I mean, since you said that post the elections, considering where we are at and everything looks good, it should not be a problem, right?
I think the US bond yield is the major determinant of where emerging market flows are, and Indian flows are a fraction or a part of the emerging market flow story. So until we see consensus on where bond yields are headed and where they are peaking, I think foreign flows will remain muted to negative. And I don't think that should be a major cause for worry, because that's happening across the board, across all emerging markets.
So say 4%, what's your target? So
yeah, I've said 4% in the beginning of this conversation. I think if that's where it is, probably in the middle of next year again, as I've said, everything should be factored in. Our elections should be behind us. So we have a clear political picture for the next 5 years, hopefully, and then we can go through the earnings and see where the growth is coming from.
Interesting. Sandeep, how does one therefore then place the bets on India? Because hitherto the last 5, 6, 7 years have been retail dominated in that sense. If we just look at the market from two funnels, which is retail versus industrials, retail has dominated, be it banking, be it discretionary or otherwise. Is it the time for industrials to start making a comeback? This result season thus far is looking positive for the industrials.
Yes. We've been saying that for some time. We've been saying that at least for the last 6 months, that it's time to look at the India industrial. So L&T reported fantastic numbers. My analyst was so excited. I have not seen him so excited for a couple of, at least 5 years. And I think this is clearly some indication that the worst is behind us. We have to see year on year and growth come through for the same name and across names in the industrial cycle. Are we at that point? Maybe we are, but it's still maybe 2 quarters of growth that needs to come through to say in certainty. So I think at this time, go for quality plays in the industrial cycle and see where it is coming from. I still don't think that the retail or the consumption cycle is something which is run off the rails. No way. I think Maruti gives a very attractive entry point. We have some new launches coming through post Diwali for Maruti, which are important models such as Ertiga, and then we have Wagon-R in the first quarter of next year. So all these models can definitely raise earnings, volumes and ASPs for the business. So that's a good thing. So I think quality names, large cap names are where we should be going. And once the political picture is clear by April, May in the second half of this year, that's when probably the mid cap and the other high beta names could be looked at. that.
The fact remains that the correction has been rather stark in the mid-cap and the small-cap end of the market. Naturally so. I mean, the small caps are besieged with these loss-making companies and therefore the index will fall more. But selectively, the beta, do you reckon, would be higher in quality small caps versus large caps? I mean, for somebody who can do the research, would you still shy away from the smaller names, and would you still bet only on the larger names? So
I would think that if you have a strong view on politics, then you should go for high quality mid caps. If you don't want to take the political risk, then wait for some clarity coming through. I don't think the economy is going to give you a negative surprise, but I think politics can easily give you a negative surprise. So you take your bets, and there's some things that can be analyzed, I've seen. Yeah. But some things are beyond analysis. You just have to take it and factor it when they happen. Yeah. So politics could be one of those things.
No, I was about to say, when you said if you have a strong view on politics, I was just asking who does, because it's just up there in the air as to what will happen.
Yes. Yeah. So that's it. So I think the risk is not from the economy. The risk is from events outside any predictability, such as politics.
Is the currency risk right now? No.
The currency was a risk. I thought the currency was too strong for last 4 years. I think that correction is in the price right now. We should depreciate by 2.5% to 3% at least. So if in 4 years, if we depreciate over 12%, and in India we see an episode of depreciation, it happens once in 4 to 5 years, and then it is 12 to 15% in that phase. We have gone through that phase. Right, and I think the macro fundamentals, everyone who's unbiased will say that they are definitely much solid than they were in the 2013 phase, when the currency again had seen a big depreciation. So all told, I think the currency depreciation is news which is behind you rather than in front of you, unless you tell me there is going to be a big war in Middle East, and because of that oil prices shoot up, because I think the global economy is cooling off in the first quarter of this next year onwards. So the oil demand should cool off. What has happened, which was a negative surprise for the oil markets, was that Venezuela went out and then Iran went out. So two big large producers went out. Now if you tell me something happens in Saudi Arabia, then that's something which is a completely different story. And again, that's an event which cannot be predicted. So I think oil prices and the Indian elections are two events which are beyond analysis.
So value creating pockets at this juncture. I mean, while you already spoke about industrials versus retail, at Macquarie, where is the value for an investor who's coming in with fresh money?
So investors who come in with fresh money, I think there's value now in large caps. As I said, Maruti is one good name. I think we could also look at IndusInd Bank. We could also look at ICICI Bank. We could also look at Axis Bank. These are all large cap names which have gone through a phase of correction. Even for stocks like Motherson Sumi, which have taken a big beating on all kind of worries because of Europe, because of China trade war, because of many other factors. Even that is a good quality name. So there's actually value in the market, which I think anyone can can say with a clear conscience that compared to 12 months ago, there's real value in this market. It's just the case that you stick to high quality names right now until we see the end of this political uncertainty within India, and then you can look at smaller cap and mid cap names later on.
Interesting. What's the view on metals and metals related pockets, Sandeep? I mean, the graphite electrode companies which have caught everybody's fancy are doing very well. That's probably a derivative of also how the steel sector does. Any thoughts on any particular themes or names within this space?
So we like metal space currently, but you tell me what's happening in China in the next 6 to 12 months. So you have a certain view that China will still continue to grow at 6.5%. If that is something which you believe in and which actually happens, then the metal names will continue to perform.
You guys have a very good coverage on commodities, which is why I thought you'll be.
So we are in the camp that there will be stability in the metal market. But again, as I said, these are events beyond analysis, because there could be something moving in the political space in those countries, and if that changes, then the markets and the growth trajectories may change. Right now, it's very clear that China doesn't want to slow down its economy beyond 6.5%. So if that is where it is, then I think the metal space, which is what our call is, will also hold up. But there's always an event risk in these kind of names.
Interesting. You sounded fairly bullish on autos. If Escorts numbers are anything to go by, the festive season delay hasn't hurt them. Maybe it wouldn't, but it hasn't hurt them. Do you expect the rest of the pack to follow suit?
I think the festive season, it is later this year than the last year. But festive season is like 3 months in a year, okay? And for the full year, we still would be growing at 10% plus in terms of two-wheelers. The real challenge has been the background in terms of interest rates going up in India and fuel prices going up in India, and therefore people feeling that the propensity to purchase two-wheelers and four-wheelers will be less. That has also come through in terms of stock prices. So from here on, I think autos are continue to be a good story. In fact, I think as far as manufacturing in India is concerned, something which India does well in the manufacturing sector is the auto sector, and that's where we have, because of big buyers such as Maruti, we have a cluster of auto ancillaries which have grown with such high quality names such as Maruti, and therefore it's an investable universe in the manufacturing space, and therefore autos is something that we continue to remain bullish on.
Okay.
IT is a pocket up until now because of the currency weakness. That was considered to be a big tailwind for IT. But, you know, post the results, most managements have come and said that they've not really received the benefit of that because they already hedged themselves closer to about 68 to the dollar. In the medium term, do you see things play out differently for this segment?
So I think it is very simplistic to assume just because the rupee falls that it will reflect in the revenues or in the earnings of IT companies in the next 6 months or 12 months. On a rolling basis, it will reflect, but it will be probably after the hedges expire and new hedges come into play. On the meantime, there are some other structural factors which are happening. It's more difficult to get with the H-1B visas, and I'm getting more expensive to do that. There's a lot of hiring which is happening onshore rather than offshore. There are also challenges in terms of where the business model is headed. Are we just going to do a labor wage arbitrage, or are we going to do some value add, which is something which the IT sector has to do? It's a 10 to 12% compounding story. You have to buy it and assume that you will get those kind of returns over a longer period of time, and therefore I think it should be part of every portfolio, because you don't have corporate governance issues in the IT space. True. which some of the other sectors have. We had like 4 years of bad news in the public sector banks, right? If you had invested even in that space, you would have made money in the IT space compared to the public sector banks. So you have to weigh what risks you are ready to take. Are you ready to take a corporate governance risk and bet on high beta and bet on no event going against you and go for a big multi-bagger, or you want a 10-12% kind of return story? And IT falls in that category where corporate governance is much lower. And so to that extent, I would think you should always have between 20 to 25% of a portfolio of a large diversified nature within the IT sector.
Just quick 30 seconds. Are you bullish on the PSU banks?
I think from here onwards, we should be bullish on PSU banks. The biggest change which has happened is the bankruptcy law, which has kicked in place. And today, lenders can control assets, which could never happen. And promoters have, therefore, an incentive not to game the system and completely put the bad debts on the banking system, which is a good thing. And if the public sector banks can continue down the path, then clearly this is a good point to get in.